Look at the instruction sheet. Okay. Look at this instruction sheet. What is written? Given the information on two funds, Franklin Templeton Prima Plus Equity Fund and SBI Magnum Gilt Fund, which is a debt fund. Okay. This is a very customized exercise which I personally created for the students to practice. Okay. And this is how usually you should even decide to invest in mutual fund after analyzing data, right? So mutual fund selection also should be basis data. It should not just be basis the brand. Okay. So using the database given of the NAV of two funds, find out the return generated on 3/11/2016 on both funds separately, as well as return generated on the overall portfolio, considering the redemption date as 14/10/2016. Okay. So what we need to basically do is we've been given two funds. Franklin Templeton, which is an equity fund. I think most of us will be aware of Franklin Templeton, right? And SBI Magnum Gilt Fund is a pretty famous government securities fund. Okay. Whoever wants to take a longer exposure to government bonds usually invest in SBI Magnum Gilt Fund. It's a pretty long old fund. And Franklin is all well known for its Prima Plus equity fund, okay, which is today is called as equity fund by Franklin Templeton Equity Fund. Now, what scenario we've been given is we need to invest 50% of our SIP. So the total SIP amount is 15,000 per month, in which I want to allocate 50% to Franklin and 50% to SBI. And then at the end, I want to calculate what kind of returns have I made. Okay. So if you see here, go to the next sheet, fund NAV, right? So you will see that I've got daily NAVs for you. Okay. This is about almost 3 years of data, 3 years of NAV data. Okay. And then what you got to do is after that, it doesn't end there, right? Because you are investing monthly, right? So do you actually need the daily NAV? So what you'll have to do is you will have to first create a series of months, date of months, then extract the NAV from this sheet out here, this database, then calculate, then invest 7,500, 7,500 to SIPs, right? And then calculate returns over the period. Now, I think till now, most of us have all the tools required to do this exercise, right? So we know how to calculate return. We know how to extract data. I think we know most of this stuff. So what I'm going to do is I'm going to give you this exercise right now itself, because I've seen a lot of people not doing exercise post class. So let's do the exercise in class. Okay, and the second part of this exercise is where it gets interesting, is where we try to compare whether this fund actually can beat Nifty also or not. Okay, let's get started then. Anybody has any questions? So don't ask me anything. Everything is given here. This is the NAV data. Okay, it's just like stock price. Mutual fund NAV is just like stock price. You can clearly see the instruction here. I'm supposed to start investing, okay, per month, considering the redemption date is 14th, 10th, 2016, right? And if you see the start date, you can assume that their start date is 1st of January 2013, 1st of January 2013 here also. And you need to calculate, you need to invest 7,500, 7,500 in both the cases. So obviously you'll have to create a separate table. It can't work here. Okay. Do not try to create the entire portfolio here, I would suggest to create another sheet where you can do the calculations and keep this as the database. Let's get started. And along the way, anybody has any query, please let me know. And first of all, I would like to see the amortization schedule by Sumedh and Omkar. And the rest others can obviously start with this exercise. Shani and Monish, did you and Richard, did you understand this question? What I just the exercise which I gave, is this clear enough? What are you supposed to do? Are you clear at least? How to do it is what you have to figure out, but what you have to do, what is the objective? Is it clear?
Sir, sorry, but can you explain what I need to do again, please?
See, simple. What? Okay, let's open the fund NAV. Do we understand what is NAV, net asset value of a mutual fund? Whenever you invest on a mutual fund, right, you have a price which you buy, right? It's just like stock price. So you go to buy a stock price, obviously it will price at 25, 30. I mean, random pricing, right? So this is that NAV here. Okay. And this is daily NAV. So if you see how many days I have out here, it's about 937 days of daily NAVs which I have downloaded and kept it for you to practice, right? Now, out here, similar SBI mutual fund also, I have about 921 days because most likely it doesn't match. You try to find NAV for one fund and you try to find NAV for the other fund. It's not necessary that you will get data for every day. Okay. So, anyways, these are two prices. Okay. Now, I'm saying you will put 50% in Franklin Templeton Prima Plus out of 15,000, and you will put the other 50% in SBI Debt Fund. Okay. Either you can create your own template by going into this sheet and creating an entire calculation on how the investment will grow. Okay. Or I would suggest to do that way only. Otherwise, I've also created a template. You can use it. If you see here, on the right hand side, if you see on the T row, I've created a template for you. But see, you have to start. I would suggest make a habit of now not using templates, because templates are, it doesn't make you think. See, now I've given you this template. Very easy, no? Now I've got the date. I need to find the NAV on that date. Then I need to find the percentage change value. Then I have to put the investment amount. So it's very, it does not make you think. And financial modeling, it's all about thinking. Okay, so this is what you have to do. On these dates, you have to find the NAVs. I've already given the monthly dates. You just need to find the NAV, find the percentage change value, by how much percentage the NAV has changed, and then grow the investment. Every month you need to put in 15,000 plus it needs to grow.
Okay, sir, got it.
Right, Richard, you're clear with this?
Yeah.
Okay, so obviously you guys will be okay right now because you saw the template, right?
Yeah.
So this is what these are the kind of templates you have to learn how to make. Okay, Munish, are you clear on what to do?
Yes, sir, but how did you get those dates? Like for
This date,
January, I see 2 dates, but yeah,
where
is
you
there
have seen 2 dates? This
no, in the template, 1 and 131.
okay, this 31. See,
Mhm.
what has happened is if you see to the left on the database, okay, you will see that I have tried. Not see that depends upon my calculation. Okay, see if I try to create a series of monthly dates, it is
Okay.
not necessary that on the day where the new month starts, I should have an NEV because that can be a Sunday, right? Or that can be a Saturday, and you might not find an NAV for that. So what I have instead done is first, obviously, whenever you try to create such a date, right, you try to create serially. I mean, you could do something like this. See, new sheet. Okay, let's say I'm creating a monthly date. So initially, obviously, you'll start by saying that okay, let's start with 1st January 2021, right? Then you will just say plus 30, right? Or could use a function. I think function is very useful. EDate. Okay. So use the EDate function, and this is the start date and 1 month. There you go. But the problem is you will be able to create a series with this. However, it is not necessary that on this date the NAV will be there. So you will have when you will use the function to find the NAV on this date, you will realize okay, there is some error. So you will try to change the date so that you actually get the NAV. This is why sometimes it will not matching. Then once you find the NAV, so you'll get NAVs here, right? Then you will find how the NAVs are changing month on month. And then you use this investment, 15,000. I've put in everything you see here on the top, 15,000, 50% on SBI, 50%. But I want you to link all of these data, okay? I don't want to do any hard coding. And then grow this portfolio till the end. It's a very interesting exercise, trust me, because you can take this exercise to another level of risk calculation, etc. I mean, we will get into that in a while, but first let's just calculate the. Let's just create the. This is also called as the capital line. I want you to create the capital line. So whenever you are analyzing something, right, you are more interested in how the investment is growing. And what we are trying to do is we are trying to create the capital line, how the capital grows with these investments. So give it a shot at least. Omkar or Sumit, can you, how is it going, buddy? The amortization schedule. Have you made it? Sumit and Omkar, have you made it? The amortization schedule question number 6. Okay. If you have about to complete, once you've done it, just post the files here. Okay. See, I will not go ahead for any student specifically into a newer case in a newer concept unless I know for sure that they have done. And the way of doing assessing that was obviously through assignments in Google Classroom. Okay. And what I've been noticing is that a couple of people have been skipping assignments uh, every week, although they do understand they've not been taking the assignment seriously. Okay, that cannot work. So if you do not want to waste the time in the class, I would suggest you complete the assignment. It doesn't take much. Okay, I think it takes just half an hour to sit on a file, think about it, and then proceed. And you submit it on the classroom. Okay, I'm doing this for you guys. Okay, this is not. I'll stop posting. I'll stop posting good exercises then, because if it's not gonna, if you just want to come and do rote learning, then it's fine. I don't have a problem. Because trust me, if you join a financial modeling class outside, by this time your course might be ending, and you would have not understood anything. Okay, I'm saying this very confidently because I had been teaching financial modeling for quite some time, and I know how it's done. Okay, because there's a constant pressure on completing the syllabus, just completing those 40 hours and exiting. And especially in online, it's crazy. Whether you understand, whether you don't understand, nobody's bothered. Okay, so, and plus you pay a lot of money. So I am doing this out of my passion. Okay, and you guys know that very well. So, just make good use of it. That's all I'm saying.
Uh, I have one question like regarding the classes.
Yeah.
Every Tuesday and Thursday we are gonna have at around 7.
Yeah. So we discussed, like we discussed last time, morning was becoming okay, and there was a lot of pressure we were putting on Saturday and Sunday.
Okay.
And what is happening is from Saturday and Sunday, we are again meeting on another week.
Okay,
And during the week, there is no interaction. Absolutely right, because we do some concept on Sunday and then we forget. So what we discussed is that okay, since 7 to 8:30 a.m. is a decent time. I mean, we're not doing 2 hours, which is doing 1.5 hour. So for example, right now, right, we might just be able to do this one case.
Okay.
But since we will meet again on Thursday, whatever assignment I give, there's a follow-up, right? Automatically. And we also are able to discuss doubts more often. See, even though I might say that you can ask me doubts anytime, but I know nobody, since nobody is doing any work on me, then what doubt will come? So it's better that we interact on Thursday. Then again, there is another case, and plus, sometimes what happens, people will have some. I've seen this happen many times. Okay, uh, people start having commitments on Sunday. Sometimes that class morning timing will get affected. Okay, so hence, what as a backup, what I've tried to do is I've tried to create, let's say, 3 classes instead. So even if Sunday does not happen for some good reason in the future, it will not affect our progress.
Okay.
And it's just, see, in weekday as it is, we are working, and as it is, we are already. Uh, uh, I mean, we are sacrificing a lot of things during the weekday, so might as well use that time rather than at least Sunday. If you want to sleep, you sleep nicely.
Yeah.
Okay, Shani, how is it going? Does this exercise look like a decent?
Yes, sir. I have calculated change value.
Okay.
Now I was going to value.
Now this is where you have to think that every month 15,000 has to be invested, plus the previous 15,000 has to increase. So you have to create portfolio line, and plus I would suggest create 2 columns. One will be the monthly investment, wherein you will show 15, 15, 15, just repeating. Okay.
Okay.
And the other column will be the portfolio line. So something like this. Okay. This will be SIP, and this will be out here portfolio. So that See, whenever you try to create such templates, you have to think the end objective. What is my end objective? To calculate returns, right?
Right.
How do I calculate returns? What function do I use? I use IRR. I will show you a modified version of IRR. But still, let's say we are going to use IRR. So if you're going to use IRR, you need the series of cash flows,
Yes.
right? So it is going to be minus, 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 minus 15,000, minus 50,000. And the end, you will have the portfolio value. So you need this column to find the final value. And you need this column, all the investments to calculate IRR. Otherwise, IRR is not going to work, right? So
That means PMT is
yeah, something like this. See,
15,000.
this much. This is what I'm saying.
No, not a 15,000.
7,500. So
7,000.
you will put something like this, right? And you'll put a dollar sign and you extend it till the end. So this gives you the monthly SIP value, right?
Yes.
This. Okay. And then this is where you need to calculate the portfolio value. Last value you can actually remove because this is when you will redeem. Because this is the redemption date.
I don't know how to do that. I will try, sir.
Right. Monish, how are you doing with this exercise? Any queries on this?
No, same. I was doing the
Yeah, do it.
percentage change.
Do it. Richard, you can also give it a shot.
Yeah, I'm trying to do.
And Shani and Shani, I'm sorry. Omkar and Sumit, I'm waiting for your files. Just give me a second. All right, where are we? So first, I hope every one of us has been able to get the NAV on these required dates. You can use VLOOKUP, you can use index and match, whatever you feel comfortable, or whichever you think is able to do it the easiest way, you can use. And for in this case, VLOOKUP works fine, right? Because the date is on the leftmost column. We're going to use a VLOOKUP function to look up the date. So we are looking up the date. The table array is going to be the two columns. Put a $sign to it. And the date which we want, the column index which we want is obviously 2, and the range lookup is 0, which is exact match. Right. I think we are pretty comfortable with now VLOOKUP. So this way you get the NAV for all the dates possible. Right. I'm sure everybody has been able to do this much.
Yes, sir.
Right. Now, the next part is obviously finding the value change. That means month on month, how much did this NAV change by how much percentage? Because that is what is actual returns for us, right? So to find the change in value, it's next month divided by last month minus 1, right? It's just a percentage calculation. So if you see here between 31st January, which is almost a proxy for 1st Feb, is the NAV changed by about 0.81%. Okay. And you just double click on that. So it should give you different percentage change for every month. But now this is where we were getting into the SIP calculation. Okay. So I think there's a column here which is unnecessary. So we start with from SIP. Okay. So in the first month, what happens? A portfolio is like the portfolio account, right? And this is getting transferred from your bank account to the portfolio account, right? So I'm just going to put this to the left so that it's easier to understand. Now, this money got debited from your bank account and it got credited into your portfolio account, right? And you can just select the area and put it into the number format. Because formatting, I believe, is in percentage. So just check that. Now, portfolio increased, the investment increased by whatever percentage change was there during that month. And plus, I'm doing minus because this is in minus, right? So minus will become plus. So your portfolio now value is 7,500, increasing by 0.81% plus 7,500, which you invested fresh on 31st Jan, right? So double click on that, and I think you should have the end value, which is about 5,18,341 on 14th/10/2016. Let me know if you got the same, 14,000, 5,18,341. Is this the value that you're getting? Let me know.
Yes, sir. Actually, my was wrong because actually my 750, 500 was in plus and I take minus. I don't know why, but
I mean, that's okay. Even if it's in plus sign, should not be a problem, because the only reason I've kept it as negative, this value, is because during IRR calculation, your investment has to be negative. Otherwise, it's like saying that I'm only getting money. right? If you're keeping it positive, it just means that you're just getting money, and then your IRR calculation will not show any number.
Oh, sorry. I was thinking that this is the Franklin Templeton account, so it may be plus.
No. Doesn't matter, no, whether it's Franklin Templeton or SBI.
Means it's coming into that account, and that's why I thought it's a plus.
Okay. Monish, does your value match the same?
Now, yes, I just followed you, but previously I didn't get to that point.
Okay. So once you've got till here, now the next step is, see, whenever you will calculate returns for any such real SIP investments or businesses where you know there is a particular date, you have to structure it in this way, okay? So that you now clearly can see there are two objectives. Okay, one is this: why have I created this X column in which I'm showing investments as negative, and at the end what I'm going to do is I'm going to show the redemption. So see here, so this is for IRR calculation. Okay, so I'm just going to show on 14/10 I redeemed this amount, right? What I'm going to do is, let's just copy this value and paste it here. Okay, just copy this value out here and paste it. Okay, now what does this cash flow look like? It says investment and then redemption, right? Now we can do the return calculation, right? So there is one way of doing return calculation is to first do it separately for two investments separately, and then we'll combine it to see what happens at the gross level. Okay. So now your IRR function has a limitation. I don't know how many of you realize that IRR assumes that everything is happening sequentially. Not necessarily that might be true for every investment, right? It might happen that, okay, you invested for 2 years and then you took a gap of 2 years and then again you started investing again. But IRR does not capture dates. That's where we're going to use the XIRR function. So just write the XIRR, right? So it's just a modified version of IRR. IRR only use values, but XIRR also considers dates. Okay, so that it's perfect calculation. Okay, so let's select the values as the entire SIP column. There you go, and comma select all the dates out here. So now IRR will calculate basis dates, not just value. It's not going to make any assumptions. So close it. And there you go. That's your 20.27% return on between 3 years. Okay. So that's the reason why I say, guys, see, I mean, this is actual data. This is no made up data. This is actual SIP data. So if you had followed a discipline, you are still making 20%. That's a huge amount of return. Okay. CAGR 20.27 is a fantastic number. I mean, you're beating inflation, you're beating everything, and you're creating wealth. Okay, let me know if this your calculation matches. This is my XIRR function. Done? Is this fine?
Sir, I am getting a number error.
Num error.
Yeah.
So num error happens if that is possible if the cash flow out here is not negative. Is this negative?
Oh, right. No, no, it's
If
not.
it's positive, then as I said, no. What you're saying is you're only getting money. You're not investing. Investing always has to be negative.
Okay, sir, I have changed it.
Right? So I suppose now you should get 20.27. Munish, I hope you got the same, and I hope Richard has also got the same, and Omkar and Sumedh, I hope you are also following now this worksheet, right?
Yeah, I got it.
Okay, so this is how you calculate returns for mutual fund specific.
Yeah.
Okay, and this is going to be a long exercise because we're not just going to stop at returns. Okay, so
Okay,
hold on.
I had one question. Like
Yeah.
this was like for SIP, and SIP usually mutual funds are they themselves have divided the equity, right?
Yeah.
So I think we can do this for even like direct equity investment also, maybe monthly.
Doesn't matter. See, it can be any investment, right?
Okay.
Right now, we're doing it for SIP because, see, you have to understand fundamentally what are we trying to do. We are saying that we are investing. So even if you're doing stock investment, it just has to appear as negative, 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 right? Whatever, whenever you, and it's not even necessary that all these values have to be same.
Okay.
Can be custom investments also, right? I mean, I'm 29th 8, I invested 15,000 on a stock. Fine. 27/12, I invested 25,000 on stock. So it's just negative, and whatever total portfolio value you have at a point in time, just take that date and put the value.
Okay.
You can do it this for property also. Let's say you bought a property on 31/12/2016. Okay. And let's say you invested. So obviously, when you will start buying the property, you have invested, right? So let's say you invested about 65 lakhs. Okay. And let's say today on what's the date today? Exactly.
16/3.
16/03/21. Right? Let's say the property value is 1.2 crores.
Okay.
Right? I suppose I've put in all the required zeros. Yeah. Now you could just use the XIRF function. Values. Rates. 15.684%. Right?
Okay.
And if you are saying that, okay, 65 lakh, I did not invest the entire amount as equity. I mean, equity meaning my own contribution. Let's say you said that you invested only 25 lakhs initially, right? Because you took it on a loan, no problem. So you just put in 2500,000, and out of this 1.2 crore, whatever is your account balance right now of loan, right? So let's say you put in that, okay, 30 lakhs is left. So you, whatever account balance you have, right, loan balance you have, you just reduce it from the property value and calculate the return. So it's about 35.58%. This is the effect of leverage. Why I keep on saying, I think you missed that class, I think on Sunday, where we were trying to understand how you actually, how magnify returns, using leverage. This is the effect of leverage, that instead of making 15%, now you're making 35% because of leverage. So this function is very useful. You see how easy it is. Just
Yeah.
rates, put in the value, you get the answer.
Yeah.
Otherwise, you will have to do, calculate the years, how many periods. You don't have to do anything. Just use the XRF function. All right. So, how are you doing? How are you doing, everyone? I mean, Manish, Omkar.
Just one more question. So,
Yeah.
for stocks, instead of NAV, it will be like the stock value.
The stock price,
Yeah, stock. Okay, yeah.
right? So the stock
it's the-
price.
Uh,
But also, what you could do is, see, if you have already done all the calculations, you wouldn't see. The reason why I'm creating such templates today is because there is a further discussion on risk which we're going to do. Okay, but if it's a stock investment, you can do something like real estate investment only. No, so let's say you, unless you are saying that you're doing it monthly. Okay, if you're doing it monthly, then create a sheet like this. But if you have just done one-time investment, then just use the property calculation. No, 31st 12 2016. How much value did you put? Okay, so I put in. Let's say you put in 50,000. Okay, wonderful. And let's say in 31st, let's say 13th 03/21, your stock value is now, let's say, 1,20,000. So how would you calculate returns? Just use XIRR. Values, dates, 23%.
okay.
Okay, so it depends upon what you are trying to achieve. So if you're just calculating return, this is fine. But if you're trying to do further calculations beyond this, then it would require you to create a template, something like this. Yeah, I think Shani wanted to ask the question. Yeah, go ahead, Shani.
No, sir. I don't.
Actually, you were not asking? Okay, I thought somebody.
Hello,
Yeah,
sir.
Omkar, tell me.
Actually, what is the solution for num error? Num error are coming.
Num error is
Definitely.
because your investment must not be negative. This values. There is no solutions. Num error is an error, right? So if you've made a mistake, then that's just showing that you've made a mistake. It's not a solution. So just check if your X column is positive or negative. Most likely it will be positive. That's the reason why you're getting num error.
Okay, sir.
Right? So if you put it in negative, you will get the answer. What about the rest? Sumedh, how are you doing?
Yes, sir, going through the screen now.
No. How much have you done this already?
Not actually, I haven't started because.
Acha, you have not started. Okay. So let me do one thing. Let me send you this updated file so that at least the next part of the same exercise, you are able to do it. Okay. So let me just send it. It can work.
I've gone through like when you are doing, but
Okay.
I need to check still.
Can you try to replicate that?
Yeah, but I need to check the file first. Then I will do.
Okay. Do you want me to send the file?
Yeah.
I'm sending you the file. Okay? Okay, if you're done with the left part of Franklin, let's move on to the SBI Magnum on the right hand side. There's another mutual fund where you're supposed to invest 50% of the rest of the money. So let's get started with that. Okay, Sumit, I've posted in Google Classroom. Just check it. Okay? It is not going through Zoom.
Okay.
Let's now move on to SBI. Same structure, same thing. Let's repeat it again. Okay. So I'm gonna start with SBI also. Okay. This is, I think, one of the most comprehensive exercise which I had created long back. I mean, as you can see with the dates, right? So I think I used this exercise somewhere in 2016, and it's comprehensive because it covers Excel, it covers returns, it covers risk. I mean, we're not got into risk right now. We're going to study risk also, because investments and making money is more of risk management rather than pursuing returns. Okay. So lookup value is this. Okay, the date. Let's use the table array of SBI. Put a dollar sign to that. Column index is 2, range is 0. Let's see. We get all the NAVs. Yeah, so this is fine. I mean, you can just remove on 14/10/2016 because we will not be investing on 14/10/2016. We will be redeeming on 14/10/2016. Okay. So we can just get, where is this? There it is. Did we invest in 14/10/2016? Oh yes, we did. So let's just there's a duplication of 14/10. What is this? So, a second. So 14/10 we will keep it open, and the last we will remove here. Okay, let's just remove. Okay, now let's just repeat the calculation. Percentage change. Today's value divided by last day's value minus 1. Let's get rid of this NA. And this is my SIP, same thing. But make sure that you are not hard coding. Instead, do 15,000 multiplied by SBI. And put a dollar sign to this. And put a negative sign. Do not make the mistake of skipping the negative sign. Okay. This is where we'll put in the redemption value. So just keep it empty. Then investment, same calculation. Increase the 7,500 by the percentage change and then adding the 7,500. And there you go. Okay, I'm not doing this slowly because I want you to try this. We're just going to match numbers, not necessarily try to do this one by one. Okay. So let's use the XRR function. And dates.
I had one question is that all these functions are actually completely same for Excel and Google Sheet, right?
I'm not really sure whether Google Sheet has this function, but it should have. I don't think so. It should not.
Yeah, they are the same, but in Google Sheet, the formulas are not mentioned. In like Excel, you can
Okay.
see.
I've actually never used it in Google Sheet, but let me just give it a shot right now. I think it should be same because spreadsheet in general tends to have similar functions, but just that it might just look a little different or might not work exactly like how it's supposed to. I mean, it does not pop up like Excel. Let me just check.
Because like my Google Sheet keeps on, like not working. Yeah, my Excel keeps like sometimes it's not working.
Okay. Yeah, it's Excel is there. Absolutely same.
It's the same. It's the
Yeah,
same.
yeah. All right. So I hope you got the returns now, which is about 12.83%. Let me know if this is matching for you. Yeah, Shani has the right answer, 12.83, perfect. Okay. Monish, I hope you got the answer right. Okay. Now, this is not where we end, okay? Because see, as an investor, we are not really, it really doesn't matter to us if we are making individual these IRRs, right? What matters to us is at a portfolio level, how much money are we making, right? Now, there's a very simple calculation to that. If you see here on the AG column, can you see the AG column? What we're going to do is we're going to add up, okay? We're going to add up both of these investments, okay? Just make sure that you put it as X20 or whatever column you have the Franklin Temple investment as. Okay. And just add this up and drag it till down. So you will have the entire value. Okay. And out here, I have put in the final redemption value of what you need to do is just add up the Franklin Templeton final value and the SBI final value. Actually, you're doing the same thing, it's just doing it in a combined way, but you're not repeating the calculation again. And you can calculate now XIRR on this also. So this gives you, okay, at a portfolio level, how much money did I make? Forget about individual schemes, investment, doesn't matter, right? But at a gross level is where you would be interested. How much money did I make? Okay. Again, use the XRR function. Take the values, entire values. Take the entire dates. Close it. So at a gross level, you made a 17% return, which is not bad. Okay. Considering that you also had a 50% exposure to a debt fund. Okay. Still you are making 17% of return. So if you were going 100%, you would have got 20.27% by just investing in equity, right? But also by investing in a debt fund, you've not really reduced your return too much. Okay. Let me know if we have reached till here. Okay. So Shani is there. I hope Munish is also there. Richard, Sumit, and Omkar. Let's quickly reach here.
How did you get the 9,65,440?
I just added these two final values.
Okay, okay, okay. Oh, yeah, got it.
Right?
Uh-huh.
Now we extend this exercise a little bit to understanding what if. Okay. So I've created a data table. Remember we discussed data table initially, right? So now what we want Excel to repeat is my XIRR calculation on a portfolio level, which is what 17.10, right? So let's do one thing. Let's link in the total portfolio values here, whatever we calculate. So what is the total portfolio value? It's 964. I want you to link it. Okay, make sure that you're linking things. Otherwise, your data table is not going to work. Your XIRR also final value, just link it from here. Okay. So everything is linked now. Okay. Now, just make sure that wherever you have used investment amounts, okay, just make sure that everything is linked. Otherwise, this value will not work. Okay. So wherever this 50% is getting multiplied, right? Make sure that's actually doing the correct calculation, right? So I mean, this is where I think we just hard coded a number, but I don't think so that should make any difference. Even here we hard coded a number, but otherwise I think we are pretty good. Let me see if we can actually remove that also. I think this should also work. So you can just remove the hard coding by just putting it the previous day's value, right? 5,18,000. So that you don't have to really do hard coding. Similarly, here also, I will select the value as So now let's create the data table. So this data table, what we're trying to do is, what if we had changed the allocation, right? What if instead of 50-50, we would have done 60-40, 70-30, 80-20, 90-10, and 100, which we already know, right? So let's link the XRR calculation out here exactly, right? Just linking this, and then select the data table. Click on data, click on what if analysis, data table. Now what's my row input? So row is this, right? Row number 9. So row number 9 data is Franklin Templeton percentage. So where is that in my original calculation? Out here. What is my column input? Out here, if you see, it's SBI allocation. Where is that in my original calculation? Out here. Press OK. So what this data table tells you is that if, since now you can clearly see, right, it's 7.10. If you just increase the decimal places, that's exactly what you're getting, right, on a 50-50 allocation. If you had increased the 60 for increased the allocation for Franklin Templeton, then you would have slightly made, let's say, about 1% more, right? 17.92. And if you keep on increasing the Franklin Templeton to, let's say, 70%, you would have again gone up, right? So at 90% allocation, Franklin Templeton, you had a 20% IRR, right? And you could do a reverse calculation also by creating another table wherein you increase the SBI allocation. Okay, but this is just returns. Okay, all this decision making on returns is never made basis looking at the returns, but rather looking at the risk. Okay, and that is where we'll get into the second part of this exercise. The first exercise is just getting used to doing such calculations.
Sorry, sir. Can you show it again? Because I am getting a wrong data. I don't know why.
Here,
Yes.
no. So what data are you getting?
16.70 in the blue.
This one?
Yeah, in there it's 17.10.
No, 17.10 is correct. No, just increase the decimal place.
Yeah, but in second row on the second column, it is getting 16.27. I don't know why it is.
And is this matching?
No, nothing is matching.
No. So then in your calculation, in your SIP investment, this one, have you selected multiplying by SBI only, or have you selected Franklin?
No, I have selected by multiplying it. Exactly, you are sure.
But SBI only, no?
Yeah.
Okay. And on the left hand side, have you done it Franklin?
Yes, sir.
Just do check this also once, because if you've selected SBI both the places, then obviously it will not work.
No, I have selected one in Franklin and one in SBI.
Okay. Then
Can you show us the? I think maybe I'm doing it wrong. The what if table.
row and what is column?
Yeah.
Okay, so let's select it again. So you select the table. Okay, go to data, what if analysis, data table. Row input is Franklin allocation. Okay, so row is this, Franklin, and column is SBI. Press OK. In data table, what row means is you have to look at the direction of the row. So ninth row, what do you have? It's like that. And column means what is there in your y column, right? So you have to look at the direction of the data.
Oh, right. Got it. I think that is the issue, maybe. But I don't know why it's actually I done it again on the taking that date. But that time also it is got wrong. I think I did some error in that.
And now it's
Okay,
working.
thank you, sir. Got it. Yeah, it's working now.
What about the rest, Monish? This works for you?
Uh, yes, yes, I got it.
Okay. I was also asking Monish, does it work for you?
Yeah, yeah.
Okay. I think then Omkar and Sumed are left. Sumed, you guys did it till here? Sumed and Omkar?
Yeah, yeah. Got it.
Okay. Now, this is where we get into the risk part. Okay. And now, all your decisions are never made on returns. Returns are fine, but risk is where the decision making actually happens, and that's where you should actually do the decision making. Okay. So, in your Google Classroom, I have also posted one material on business risk measurement. Okay. There is a PPT out there. Just open that PPT at your end. Okay. And what we will do is we'll try to learn the entire statistics plus risk measurements. Okay. Using this exercise, but not today. Okay. Not today. But we will calculate each and everything which has been mentioned out here in this presentation. Okay. So let me just quickly share uh, what all we're going to be covering. Okay. So this is a part of statistics only, but generally people do not understand statistics until you actually apply it. And I think investments is a perfect place to apply, risk measurement. For example, we will create a distribution chart for the returns. Okay. Uh, you have to understand that the Six Sigma events that people talk about, right? Returns becoming minus 20, returns becoming plus 60. Those are just one-off events. And where does the maximum amount of occurrences happen? And theoretically, we know there is something called as normal distribution. I think every one of us has gone through somewhere in our life what is a normal distribution, right? But we will see it in practice. So we'll create frequency distribution. Okay. Then we will try to understand the central tendency. Okay. We will calculate mean returns, but we will also understand the challenges of mean returns. Okay. Why mean is a can I mean give you wrong inference. Okay. Challenges of mean, because a lot of calculations. How many of us have heard about Sharpe ratio, right? All the risk adjusted return formulas in the market, which mutual fund usually will talk about, is based on mean, right? Averages. But that is where we'll understand the challenges of averages and hence the challenges of Sharpe ratio. Okay, so median and mode is what we will also cover. Then that is where we'll come to risk. That is where we start from dispersion. Okay, all these terms we must have somewhere in our lives come across: range, variance, standard deviation. But what is the inference to get of all these dispersion techniques is once we actually apply it with this file, you will be able to get better clarity. So you understand whenever you are explaining someone what does actually standard deviation mean in practice, will be much more clearer. Okay, we'll calculate standard deviation, we'll calculate variance, we'll infer it. We'll also go through one uh, theory on Chebyshev's inequality, right? I don't know how many of you are aware of this. So Chebyshev has actually given a very small, what you can say, standards as to how many proportion of things happen in certain, standard deviations. So right now, obviously, when I say all these things, it will be confusing. But this is where we will complete all the risk and return measurement calculation using the same exercise. Okay. And plus, I will send you another exercise, something similar to this. Once we're done with the SIP exercise, for you to try it out with a different set of data. Okay. And that is where we will conclude time value of money, Excel, and risk. So we have all the tools necessary to now jumping into modeling. Okay. And that is where we get into now business modeling. Plus, we will also touch upon a little bit of accounting, because I'm sure whether or not we know accounting, I mean, we will need a refresher, and that also we will be doing hands-on, no theory along with it. Okay. So that is where I would like to conclude the class today. If anybody, I'm sure Sumit and Omkar, you must be having doubts in this exercise today. So I'm going to do is I'm going to post this file on the classwork, the stream, so that you can just have a look into it, whether you've done it correctly or not. And let's meet on Thursday. Okay. And meanwhile, if anybody wants to ask any questions, please go ahead.
Okay, this is like totally. It's not very useful question, but then can you tell me
Every
how?
question is useful question.
Can you tell me how NAV is calculated?
The net asset value is very simple.